Welcome back from the break. Let's quickly bring you the activities, the Financial Inclusion Summit I told you that was held just a few days ago, that Moneyline with Nancy. I was there. We had different discussions, at least to give you an insight into financial inclusion in Nigeria. Don't also forget that we've seen that the new Naira notes have been launched. We have a new 200, 500, and 1,000 Naira. How far or how many more years will it take Nigeria, the Nigerian population, to be financially included? So I would leave you in safe hands. Just take a listen to how the proceedings went.
At the onset of my administration, we developed a blueprint for economic growth and development called the Economic Recovery and Growth Plan, ERGP. The plan was focused on economic recovery in the short term and sustained growth and development in the long term. This plan enabled this administration through its flagship agricultural initiative, the Anchor Borrowers Program, of course, under the central bank, to provide access to credit. Farmers were required to open a bank account to access this facility, and this marked the first time many of them had accounts and has consequently led to the growth of financial inclusion amongst this underserved segment. This administration understands the impact of financial inclusion on economic growth and development, and as such has provided the enabling policy environment for financial inclusion initiatives to yield the expected results. For instance, in the year 2019, I launched the micro pension policy, within which was aimed at deepening pension penetration among the MSMEs and the informal economy generally. We also initiated policies for microinsurance and collective investment. These initiatives are geared towards providing access to a wide range of financial products and services to the underserved, in line with our national financial inclusion objective. This administration understands that it will require innovative models to fast-track the attainment of its growth plans. The place of fundamental infrastructure like citizens' identity database and broadband internet is central to the attainment of digital economy strategy. And to that effect, over 90 million Nigerians have now been captured in the national identity database. Also, a broadband penetration strategy with specific targets have also been developed and is being gradually implemented.
Today's event is jointly hosted by the Central Bank of Nigeria and our partner stakeholders within the National Financial Inclusion Governance Committees. In line with extant statutes, the Financial Inclusion Steering Committee is the apex body responsible for implementing the Nigerian Financial Inclusion Strategy and ensuring the alignment of financial inclusion policy objectives to the inclusive development objective of the federal government of Nigeria. The global meltdown in 2008 made financial services regulators focus on improving financial system stability and mitigating risks that could lead to a future recurrence. Nigeria implemented a tighter prudential regime to respond to the meltdown. While this effort improved financial system stability, it inadvertently undermined access to finance as entry barriers to the financial system became a disincentive for many economically active Nigerians. The response to the global event in 2008 was not entirely responsible for the low access to finance for the underserved in Nigeria. Infrastructural deficits like low broadband penetration, lack of a functional national identity system, and high cost of delivering financial services through bank branches to the underserved contributed to Nigeria's financial exclusion situation. As at 2008, 52.2% of Nigerian adults were financially excluded. This implied that 1 out of every 2 adults had no access to financial services in Nigeria. Even though Nigeria had a sizable number of banked population, our financial inclusion rate was one of the lowest in the sub-region. And more worrisome was the fact that many adults were financially excluded. Youths aged between 18 and 35, and our micro, small, and medium enterprises that employed over 60% of Nigerians were disproportionately excluded from access to financial products and services. Consequently, stakeholders undertook the onerous task of driving access to finance for the benefit of the hitherto excluded segments through the National Financial Inclusion Strategy. As at the end of 2020, the financial exclusion rate had reduced to 35.9%. While this remains high, when considered as absolute numbers, it is a huge improvement when compared to the position as at 2008. This change did not happen by accident, but resulted from the decisive and concerted approach by the national financial inclusion stakeholders to address key pain points and bottlenecks that were deterring financial inclusion in Nigeria. Your Excellency, distinguished ladies and gentlemen, financial inclusion is key to economic development and inclusive growth in any country. Various up-to-date researches and painstaking analysis show a positive correlation between financial inclusion rate of a country and its GDP growth. As such, our focus on financial inclusion was imperative to ensure sustainable development and growth in the Nigerian economy.
A lot has changed in a decade, I'm sure you would agree. Innovation, digital technology, internet, social media have transformed every aspect of our lives. The fact that this conference is held in a hybrid format, I think, is a case in point. Some of the biggest impacts we've seen in technology have occurred in the global payments and financial system. We've seen mobile and electronic banking changing the way we deliver and access financial services and opening new vistas for financial inclusion worldwide. Nigeria joined 10 founding members of the Alliance for Financial Inclusion, signing the Maya Accord and committing to reducing financial exclusion in their respective countries. We launched our targets in 2012, aiming to ensure 80% financial inclusion of Nigerians by 2020. We've made significant progress in this respect. We've improved financial inclusion to 64.1% from 53.7% when we started. This is despite remarkable population growth annually over that same period. But perhaps more importantly, we're very proud of the rapid digital innovation and the concerted policy initiatives of the CBN and other sector regulators that is transforming the banking and payment system in Nigeria. These efforts are enabling technology-driven solutions to the key challenges of lack of KYC, digital identity, financial access points, and robust payment infrastructure that we find in many excluded economies. Nigeria, indeed, is at a tipping point for financial inclusion. I dare say at no time has there been such a prevalence of an enabling regulatory environment, the proliferation of digital technology, innovation, and the collaborative will to ensure that we achieve financial inclusion for all.
The World Bank Global FinTech Survey shows only a 5% growth in financial inclusion between 2017 and 2021. And managing economic shocks remain difficult. Only 14% of adults today can come up with emergency funds without much difficulty. Now, this new strategy offers a genuine chance to achieve a common vision that every Nigerian, no matter their background, geography, or gender, can improve their lives through access to quality financial services. Now's the time for action and innovative solutions to seize the many new opportunities before us. First, we have a chance to significantly increase access to digital identification, which is critical for service delivery from finance to health and education. The growth in enrollment for national identification numbers, now above 89 million, is an encouraging development. Moving forward, we can explore how the NIN and banking verification numbers can better integrate and complement each other's objectives. Quick passage of the Data Protection Act will further support digital service delivery. Second, we can ensure that services and businesses are able to sustainably reach the last mile. This includes the fintech sector, whose impact on financial inclusion has untapped potential, which can be enhanced through a range of policy measures. Making fully operational the regulatory sandbox efforts and simplifying licensing frameworks will be really key here. Making full use of tiered KYC rules for low-income and rural customers, expanding shared agent networks, and further investing in mobile and data network coverage is key to reach rural clients, including in northern states. Third, this is an opportune moment to close the financial gender divide in Nigeria, which at 20% remains significantly higher than the sub-Saharan average. Ensuring gender parity in access to digital IDs, mobile phones, and digital connectivity is an ideal place to start.
As we've heard, we have done incredibly well in the last 12 years, but we are still short of our target. And the question for us is, what do we need to do differently? The question that we must first answer is, what is the last mile? Because the traditional use of the phrase last mile might be different from what it means in the financial inclusion space. So we need to ask ourselves, what is the last mile? Where is the last mile? And who is in the last mile? And I'm going to start, not with my regulator, so that I can allow the operator the freedom to express themselves. Tommy, you have had the opportunity of being on the street, of talking to people across this country in different communities. You've seen the various nuances. You've seen the idea of one country but multiple economies. Yeah. You've seen the differences across gender. My first question to you, and that would allow you to obviously introduce the way you view the topic, is where is the last mile? Thank you.
Thank you so much, Mr. Suleiman. Thank you, everyone. Would use my favorite saying in public sector: I stand on all existing protocol. And so I would share based on my experience. I think I'm a scientist by training, and I'm a researcher by heart. So I think a few years ago, the question I was asking myself through a research team I joined was, first, why is it that certain products, I don't want to name brands, alcohol brands, cigarette brands, the minute they come into Nigeria, you could find them in communities we consider excluded, in remote northern villages, in remote northern communities. And I asked and said, why is something as critical as financial services that is connected to poverty alleviation, that is connected to being outside of the shadow economy, that is connected to identity validation, not something that we're seeing there. So the truth is, the last mile is, it's not a destination, it's kind of a journey. I like to see the market in like 3 pyramids, or should I say 3 steps, 3 phases. At the top of that is many of us in this room. At the second level, because if I'm going to pay anyone in this room, I probably don't need cash. I don't think I have 1,000 naira in my bag, because all of us inside this room are what we'll consider, I think, digitally included. But now we have another segment. I live in Lagos. If I have to go to Oniru market, as much as I don't have to carry cash, I would. If my housekeeper needs to go, even if I transfer money to her, the minute she gets there, she goes to use a POS machine to withdraw cash. Now the problem now is that we that are included have to connect with another segment, and we have to move away from the digital form into cash form to serve them, which cost of printing money, cost of too many things, and then just crime, all of those things happening. Then you then have the bottom of the pyramid, which those people are serving. So in a nutshell, we do have the last mile, sometimes within the urban area. You do have the last mile in places I call peri-urban, and then you have a large expanse of them in the bottom of the pyramid in should I call it, rural communities.
Coming to my regulator, Mr. Jimoh, you are in a unique position to see all the models that has come through this country. You've seen the bank model, you've seen the fintech model, you've seen all of the effort, and in fact, you have to approve them for them to be out there, at least if they have some element of payment included in it. What are the models that you've seen? What has been your experience? And which of these models do you think we should be focusing on if we want to scale for the last mile?
Thank you very much. Let me start discussing this by starting from, where the entire conversation was about 10 years ago. We had a situation in this country where people do not have verifiable credentials. If you go to a bank and you want to open a bank account, the first thing they ask you is to bring an international passport, or you bring a valid driver's license. We had a situation in this country where we've had that, you put your money in your bank account, and over time, it's eroded by the interest, that your bank charges them. And so we have myriads of problems that are actually pushing people away from the financial sector. And what the central bank as a regulator has done was to identify this problem and begin to solve it through regulatory intervention. So we came up with the mobile money regulations, basically to push digital financial services to the nooks and crannies of this country. We also came with the 3-tier KYC. The DG talked about it. Reason was because we actually wanted to tier the requirements for having access to bank accounts, so you didn't need to have those kind of stringent identification documents to open a bank account. And so we also came with a cashless policy, with the hope that with digitalization and enabling of financial touch points, it will bring down the cost of banking products, and therefore translates to reduced fees and charges that we give to the customers. Now we've moved beyond that. That's no longer the conversation. We actually moved beyond that. The conversation now is about the fitness of the products and services. The products and services that we're actually giving these people, do they fit them? Yeah, you can bring a lot of products and services. If it doesn't fit my need, I won't use it. That's why you have a lot of dormant accounts. That's why you have a lot of accounts that are open but are not used, because the products and services for which they were open for do not fit them. So what I think the conversation should be now is about what kind of creative products, what kind of initiative can we bring into financial system, into banking system, such that those products and services will fit those people that are excluded. And I think that is where the regulator comes in, by providing a regulatory environment that will enable and stimulate innovation. And so we'll be talking about various technology innovation like USSD, innovation. You talk about the contactless, you talk about the offline, just like the keynote speaker talked about it. Offline is very, very important, because you don't have pervasive digital signal in all the nooks and crannies of this country. There are places you go where you'll be struggling to have access to digital signal, and so your phone or your POS will not work. And so what we try to do now is to look at how can you provide services to those who are not digitally connected. So offline is very key. You also talked about digital identification. People need to be digitally identified. And so digital KYC is very, very important. How do you identify people? How do you ensure account ownership, that the person who says is the owner of account is truly the owner of the account? And with that level of identification, banks and other financial service providers are able to provide credit because they know you, they trust you, they have everything that they can use to trace you. And so what we have done in all of these is to provide environment where the startups, the innovators, the fintechs, and all payment service providers can come together and give innovative products. So as regulators, we come out with regulations, we come out with contactless regulation, we have come out with open banking, we've come out with Innovation Sandbox. Innovation Sandbox basically is an environment where people that do not have CBN license, people that are not being granted license to operate, can actually come and showcase their idea. To get a license from CBN, you need to apply, pay for application fee, and eventually when you are given your license, you pay for licensing fee, including having stringent conditions of making sure that you are a registered entity. If you're not registered, if you're not a registered company, we'll probably not listen to you. Now we want to provide an environment where you don't have to be a company, you don't have to have an MD, a CEO, and all of that. You don't need to, even have 100,000 naira to apply for license. All you just need to do is to come within that box. We grant you the opportunity to test your innovative ideas, which we sure will help in promoting financial inclusion. Come and test it, connect with all the entities in the ecosystem, the banks and the payment service providers, and test this product. And once it becomes viable, economically viable and feasible, then you can then take it and promote it, thereby making it commercially viable to the entities. Those are the steps that we're taking now, and I think this is the action that I think all the banks, all the digital service providers, and other payment service providers should come together as an ecosystem, including other regulatory agencies like the NCC and the NDIC coming together, working together to make sure we advance financial inclusion.
I want to bring in Dayo. One of the risks we ran with financial inclusion was that we started to treat it as if it is synonymous with payment inclusion. And that once the payment rails were put out and people were on it, we assumed that people were financially included. The problem being that that does not create the prosperity that it is intended. The question that I was going to put to Dayo is, from the Securities and Exchange Commission's perspective, have they started to look at financial inclusion as something that they're going to push aggressively, and what would be their roadmap so that we bring in investment into the financial inclusion space?
Will we ever say we're on the last mile? It will keep moving. The population keeps moving. Like, for example, the reason why I'm not able to join you physically is because we are launching our revised capital market master plan, which is a document we created almost about 6-7 years ago. But a lot of things have changed and will keep changing, and that's why nothing should be static. So what is the SEC doing? First is, and I'd like to say that in relation to where we're at as a nation, and what we need to do to cover this last mile. Last mile, in definition of it, will now depend on where we are at the moment. Remember, 5-6 years ago, digitization was more popular. Then digitalization. Now we're dealing with so many things around technology, fintech, cryptos, and all of that. So things will keep moving. Now, so I'll just answer your question in several ways. Last mile. Currently, now, digitization of processes, digitalization of processes, quickly making sure that processes around the regulatory space in the capital markets move fast enough. Gone are those days, when computers first came, you were so excited you had a computer. Now, if a page, we millennials, if we're trying to load a page and it comes up in more than a minute, we move to another page. So it's not just about the technology being available, it's been fully operational to address what we want. Secondly, now that is the current. So leveraging technology to address or to keep the interest of the current teaming or new investors is one of the ways we are looking at covering the last mile. And I'll just give you some statistics that helps. For example, in Nigeria now, one of the statistics we have gives an indication, or gave an indication just about a year ago, that the average age of investors in the capital markets in Nigeria was about 50. Well, you'll agree with me that's an aging population in a country where you have over 40% between 39 downwards, maybe between 15 to 39 or thereabout. So what had to happen? You need to adopt technology. Technology, by one single transaction that we adopted technology in just digitalizing the process of helping people come on board. That's one of the transactions of one of the telcos. Not alone did he address female inclusion, he addressed getting more youth into the investment bracket. That's because they opened new accounts. A lot of them were first-time buyers in the capital market. And more importantly, it just helped. I mean, the statistics we still have indicate that the average age, by that singular action, helped crash average age of investors from about 50 years plus to about 30 years plus. Imagine if all the initial public offerings are now digitalized and all documents digitized so that everybody doesn't have to seek and get a prospectus and hard copy, annual accounts, everything is at the flick of a phone. It will definitely help. So that's currently. Secondly, what about the people coming behind? So that's where financial literacy and investor education comes along. So at the SEC, we recognize that is in fact one of the integral parts of our capital market master plan, which, like I said earlier, we've revised, we're launching. The Honorable Minister will be doing that in a couple of minutes. I just took time out to quickly join us because we at the SEC, we are not only an integral part of this advocacy and this drive. It's something we do, we almost breathe it. Within this SEC, we have almost about 3 desks. We have an investor education desk, we have an innovation desk, we have a financial inclusion desk specifically just to keep driving this. Then talking about the future, so I've spoken about the current. Currently now we're doing digitizing and digitalizing processes just to make it faster and easier for people to onboard. And that speaks to identity management, uniform identification, which we get to speak to other agencies about just to make things easier so that there's a central, or should I say a more common pool where identity of investors or to-be investors or people that want to access financial service can be easily drawn off. We've seen the success of the BVN. We want to replicate that. We've seen the identity management part of it, we've seen how that comes. So those are things we're leveraging on. You have a core responsibility of developing the market as well. Thank you very much.
Do we see a set of collaboration between the central bank, the NCC, the SEC, and a couple of other top regulators to create the pathway that will take what I would call the rails into the final frontier? And what are these ideas that we should be looking forward to?
Yeah, thank you very much. Truly, infrastructure challenge is one of the major challenges that we have. Without digital presence or telecommunication presence in an area, there is no way you can deliver digital financial services, because as it is today, most of our financial services are done on handheld devices, our phone, our tablet, and all that. And everybody needs signal, everybody needs data. So question is, how do you achieve it? Central bank doesn't regulate the telecommunication industry. And even the money that is kept in the bank or with other financial service providers needs to be insured. Central bank doesn't take care of the insurance policies and the insurance protection. And so we have a lot of regulators that we need to discuss with and work with. We have a very strong relationship with NCC. We actually have a joint technical committee involving the 2 institutions, and the objective is to promote digital financial services. And so what we do is that in our regulation, and as you know, central bank today, we don't just wake up and then push out regulation. What we normally do in the first place is to call the stakeholders to come and review. We expose to the industry for them to bring their feedback and all that. With NCC, for example, in our mobile money regulations, they were deeply involved. Because for any device to connect to their network and provide financial services, as I understand, it has to be type approved. And so NCC comes in there. They also come in terms of regulating the telecommunication service providers. We leverage on their infrastructure. DUSSD is a telecommunication service. The SMS is a telecommunication service. As a matter of fact, all the backbones connecting the banks, all the devices performing financial services is being provided by telecommunication service providers. So we need NCC, and that's why we strongly collaborate with them. We also work with NIDA, the Nigerian Information Technology Development Agency. They are also very, very involved now that they are even regulating the privacy law. They are also very key. NDICC makes sure that confidence is provided in the financial services. Consumers and account holders are able to be assured that their money is safe, and that in the event of insolvency, their monies can be paid to them. So what we did with NDIC, for example, in running mobile money is to provide what we call the pass-through insurance, whereby all the wallet holders are indirectly insured by their deposit that is kept in the bank. And so we also work with them very well in doing that. So stakeholder engagement is something that we practice very well in CBN, and I think we are doing very well with regard to that. But we still need to expand that. We still need to expand that and bring in more other agencies. They may not be regulatory, but other agencies. So we have development partners that we work with. For example, we have the FinTech Association of Nigeria. We have several organizations in and outside of the country that we work with, just basically to understand what happens outside the shore of this country. And some areas that we do not have access to. Not everyone wants to come to CBN. A lot of people, when they see CBN, seated in any, event, they just don't want to come because they don't know their mission. And so what we do is to actually partner with some agencies. We hibernate under those agencies to make them come. And that's what we basically do. So we talk about the innovation hubs. We talked about the financial services agencies. And so that collaboration is very important. And I like, where somebody made the statement just now that regulation and oversight has gone beyond just coming out and be raising your hammer. You need to collaborate. And so what we do is to have that strong collaboration. And one of the methods by which we want to achieve that is the innovation sandbox that we have also brought, and making sure that we can bring people that are not even within our regulatory overview to come and talk to us. We can't supervise, we can't provide good conduct within the environment if we don't study, if we don't collaborate. So we will continue to do that with all agencies that are involved in regulating financial sector, in promoting digital economy in such a way that everybody is digitally connected, in order that we can leverage our financial services on them.
Now, Tommy, this is a question for you. The challenge of credit seems to me to go beyond those that are excluded. If we've exceeded 50% financial inclusion and we're struggling at 3% access to credit, this is a problem that obviously banks should be dealing with. But more importantly, and I think this is something that you would have encountered, what is the challenge?
All right, thank you. I can't speak for the banks. I would speak in two ways. I'll speak as a bank's customer and my experience with credits, and then I'll speak for the low-income segment or the excluded. I think for the bank, there's the need to leverage the data more, and I think also the robust use of identity data that we have, and thirdly, more around being able to the global GSI. I'm quite excited about how that will work out, because everyone wants to be protected, and if default is high, it's impossible you're going to be losing real shareholder funds. But one of the things I think the banks are not doing quite well, and I'm speaking as a customer, is for one of the top tier banks, I've been a customer for 15 years. I opened my first bank account in 2007. I think I was in 200 level or so, do the maths. And I used the account all through university. I became a copper. I started my first job. I went for my master's. I started my first company. I got married. Kate. And I realized that the richness of the data they have about me compared to how they're able to serve me, from all of my addresses to all of my jobs, they know me. So how are they not able to? And I recently went on that platform and tried to take credit, and I was eligible for 0. Meanwhile, I have a platinum card. So how can a platinum card carrying customer be eligible for 0? And even more so when I started Bankly, is how interesting that the bank wasn't the first to bank my company. And that's my thought about the banks. But I also understand that they have limitations around the richness of the data. So maybe now I have BVN. How is it plugged to my NIN? How is it plugged to my address in a way that a single number of me can pull up my car registration number, my data, and all of that. So that's that. Now, from Bankly's experience, so for instance, for the last mile, a few years ago when we started, like I mentioned, we realized that local women communities were saving. They were saving informally, which shows that there's a way they wanted to be included, or they wanted to put money away as cash. So they started saving with people we call in Southwest Alajo. Now, not the group one we thought. The Alajo will go into the market with his bag, register them on a piece of paper, and they will record. And every day is collecting money from them. There were 3 issues we found for that. The first one was there were cases around fraud. The Alajo will have collected, or the thrift collector will have collected hundreds of people's money, and on one fateful day is nowhere to be found. There were cases that was brought to us that the Alajo died. And I'm sorry to say, but if something happens to the CEO of the bank I banked, I won't lose sleep. Because if he's dead tomorrow, my money is safe. But if the Alajo dies, that's the end of it. Their funds are gone. The second thing was access, meaning if you're saving in a certain location, you might be saving in Ikorodu in Lagos, and you go to Abia State to visit your mother, then an emergency, the whole point of the savings or the putting something away is because you want for rainy day. You found your mom sick, but you need to eyeball your Alajo to get your money back. The third issue was cost. They were paying 1 out of 30 days to save. That's 3.3%. In a year, that's about 40%. Meanwhile, they were losing money to save. So one of the things we did was, how can we first digitize this process? Which, like Mr. Jimoh said correctly, is that some of the products that was available wasn't serving these people where you don't come to them and say, oh, open a bank account. Because a bank account sometimes requires that your money is digital, or you need to work, or your source of funding is digital. So we started digitizing this process, and also they were getting credit from these people. So sometimes the reason why they're saving is that the day the shop owner comes and wants to collect money for the shop, that's the person that saved them, even though the rate can be almost like a loan shark, but it was available, it was accessible. But what we found is that as we try to leverage collaboration to build on these roles, to digitize them, we quickly found that it wasn't that possible. So we had to take multiple step backs and realize it would take 3 pillars. The first, we had to build the distribution rails ourselves. I have to say that Mr. Jimoh really, sometimes people run from CBN. Maybe that's why I'm one of the people sitting here. Years ago, I used to pursue Mr. and say, I'll be asking him several questions. I'm sure he'll just be tired of me, and he'll be answering me, not wondering. But he actually gave me insight in a way that, whether he knew it or not, that as I was designing what model we're going to serve, I was using some of the insight he was sharing. And at the point where I finished the pilot, I went to them and said, hey, I've done the pilot, I want a license. And so that's how you could engage. I was engaging him way before I had a license. And I think startups need to know that they are accessible in that manner. So now, coming back to credit, if you don't digitize that savings, how would I know that Mama Aisha has a disposable income of 100,000, and then that disposable income informs how much credit I can give to her? How would I know how much she needs for akara every morning so that I can give her, even if it's a 48-hour loan? And it goes back to, first, you need to have a distribution system. The second, educate them, because if you're going to give them digital product, you need to educate them. And we found that education is across different geographies, education is necessary and in different ways. So sometimes Southwest, they understand the fraud and the security stuff. But I've had to deal with people in northern Nigeria, whereby in a WhatsApp group, they will drop, oh, I have an issue, and their PIN and their password is right there, and 200 people are on that WhatsApp group. So if you're going to be treating and to be digitizing these people, you need to also educate them. And finally, you're not able to use that data, that digital data, to give them credit, and then credit can then get to the last mile. But if the banks are not using the data to digitize me, we would remain at 3%.
Again, I think the call to action is that financial literacy and financial inclusion must go hand to hand. Now, Dayo, what are the other aspects of progress that is required for financial inclusion and the last mile to deliver prosperity? Because at the end of the day, financial inclusion is supposed to be about prosperity for those that are excluded.
Okay, I'll just speak to it this way. I think financial literacy and investor education, whatever nomenclature it is, one thing I'll say as my parting shot is we need to move from the delivery of financial literacy. You printing a pamphlet or printing a flyer with a glossary of terms doesn't cut it. When you speak more to people, is linking that knowledge to creation of a solution to a problem. It is easier to tell someone that, oh, in order for you to get money faster from your son in the city, open a bank account, as opposed to telling them that it's somewhere for safekeeping. The person in the rural area, they've been burying it in the bottom of pots or under their mattresses or mats for years, even before I was conceived, and it worked well for them. So you printing a pamphlet or a flyer or coming out with a message about safety won't cut it. But if it's in relation to solving a problem, it will help.
Thank you. That is very helpful, and I think I'm going to tie that to when I take the last comment from Mr. Jimo. This is not directly to you, but I think you can help. At what level should financial literacy be included in school curriculum? In other words, how early should we prioritize this in our schools?
I think we should have done it like 10 years ago. It's too late, and we don't have to wait any longer. Happily enough, there is social media, and every kids today, every secondary school, even primary school pupil have access to digital platform. Some of them actually have their hashtag on social media platform. We can leverage on that and push, financial literacy, digital education to them. For those in the hinterland, for those that are not, connected to us, those of us in cities, we don't even have smartphone to have digital presence. We'd have to take the literacy campaign to them, working with the local governments and the state governments and all that, the chiefs, the local chiefs, the religious leaders.
Should we include it in our school curriculum?
I think we should. That's what I'm saying. We should have even done it 10
And the
years ago. So
curriculum.
right now we should.
Okay.
And I think it won't be too late to do that.
No, thank you very much. And from Tommy, if you had a blank check to ask the regulator for something that would let us get to the 95% inclusion that we seek, don't be ashamed, and don't be afraid. What would you ask for?
I think one of the things I'll ask for, from my experience, is the timeliness to which we get responses from I know that they are busy, but sometimes you apply for a license based on an opportunity in the market, based on a challenge in that time, and you might not get response in 18 months. And that timeline, life changes, things move, and and 2 years. Secondly, is also to be able to, so sometimes innovation needs to take, you might not have all of the money in the world to go straight to the top and go get a certain license, so you need to start small. Now, as your transactions are getting to a threshold that you feel like, hey, I want to write to the regulators, I need to upgrade, there should be that open communication to be saying, I'm requesting that this is where I am, I want to upgrade, before you get in trouble. Thank you.
what I would say to everyone in this room is that this is one area where the regulator, at least the banking regulator, has led. And it is a rare thing. Usually we try to go forward and they pull us back. As we round up, our takeaway from here is that we must build on identity. We must build on offline payment system. We must also collaborate to deliver infrastructure. And finally, the data that is available both in the banking and outside banking, we should use it collectively to increase the available credit to the system. For it is on the back of credit that we can grow this economy. Thank you very much.
Welcome back. I hope at least that we picked one or two things from what we've shown you today. That's the much we can take on today's edition of the program. Thank you all for joining us. I am Nancy Naji. Be the best you can be and be the change that you want to see. Bye for now.